Bismillahirrahmanirrahim. I am your teacher Gulfam Bano. Today we are going to discuss about national income. As we know that the economy of a country can be studied in two parts. Micro and macro analysis of economy, which are called micro and macroeconomics. In part 1 of the book, we study microeconomics. This means that part 1 of the book deal with the individual aspects of economy. In this part of the book, we are concerned with the macroeconomics. In macroeconomics, we study the economy of a country in large aggregate. For example, aggregate output, aggregate national income, aggregate consumption, aggregate saving, and so on. We start this part of the book from the firm concepts of macroeconomics, which is national income. Here are the definition of national income. According to Samuelson, it is loose name we give for the money measure of the overall annual flow of goods and services in an economy. This definition clearly out the money value of all the final goods and services produced in a country in a year is added up. The total value is called national income. For example, money value of annual production of rice, wheat, radio, etc. is added up to calculate national income. According to the second definition, Gardner defined as individual income is the amount of his earning from the productive services currently rendered by him or by his property. National income is nothing more than the sum of individual income. According to this definition, individual income depends upon two things. The one is productive services of the individual. The another one is productive services of the property. Thus, individual in a country contributes in the production process in the form of labor, land, capital, and organization for which they get individual income in the form of rent, interest, wages, and profit. The sum total of these individual income, or in other words, the total of aggregate annual wages, rent, interest, and profit will be result in national income. Here are some concepts of national income: gross national product, net national product, national income, disposable personal income, per capita income. In this lecture, we will discuss only first three concepts. The first concept is gross national product. It is the aggregate money value of all the final goods and services produced in a country in 1 year. In order to calculate the money value of the good, only final goods are taken in account. For example, shoes, wheat, rice, etc. As for services, for example, doctor, teacher, engineer, etc. are concerned, they are always performed in their final form. Thus, their money value is straightaway added with money value of final goods in measurement of GNP. Thus, aggregate money value of all the final goods and services added together will make GNP. In order to calculate GNP, following expenditures are added up: personal consumption expenditure, gross domestic private investment, gross domestic government investment on goods and services, gross domestic public investment, export surplus, and net foreign investment. The second concept is net national product. It is defined as It is the monetary value of finished goods and services produced by countries, citizens, overseas, and domestically in a given period. While calculating GNP of a country, we include the expenditures made on the purchases of machinery. These expenditures are included as gross domestic private investment and gross domestic public investment. Money value of machines keeps on going down during the year due to replacement. In order to calculate their exact net money value during the year, the depreciation cost of machine is subtracted from their market price. Here are the formula to find net national product. NNP is equal to GNP minus depreciation cost. The third concept is national income. As defined earlier, it is the money value of all the final goods and services produced in a country in a year is called national income. We know that the money value of goods and services in a year is determined by the expenditures of the people. To arrive at these expenditures, following items are adjusted with NNP. Here are the formula of national income. NI is equal to NNP plus government subsidies minus indirect taxes minus transfer payment.